This is StockMarkets Explained. Welcome. In today's video, we'll be talking about Africa's stock market boom. And the question that we're asking here is, who is actually getting richer? Ghana and Nigeria are sitting near the top of the global stock market league table in 2026. The Bloomberg ranking cited Ghana Composite Index having delivered about 66.7% of in US dollar terms, putting it second globally, while Nigeria's NGX All-Share Index stood at roughly 65.2%. That it was in the third place. South Korea KOSPI was ahead at about 68.5%, but behind those extraordinary numbers is a more complicated story, one involving currency stability, economic reforms, corporate earnings, investor confidence, and most importantly, a question that markets alone cannot answer. And the question is, are ordinary Ghanaians as well as Nigerians actually becoming better off? That distinction matters because a stock market index is not a household welfare index. A market can rise sharply while millions of people remain unable to afford food, housing, healthcare, or reliable electricity. So as Africa's equities attract global attention, the real story is not simply how high the markets have climbed, but what is driving that climb, who owns the assets, and whether the gains are translating into broader economic opportunities. The performance itself is difficult to dismiss. Ghana's own exchange data shows that GSE Composite Index moved up 75.99% in the local currency terms between January 1st and July 31st, 2026, illustrating just how powerful the rally has been. Nigeria, meanwhile, had already recorded a 59.5% dollar return by June 2024, according to market data cited in Business Day, with Ghana at 57.7% at that point. The precise ranking changes with market prices and exchange rates, so the Bloomberg figures should be understood as a snapshot rather than a permanent proposition on global scoreboard. These are sound economic reasons. There's sound economic reasons behind the enthusiasm. In Ghana, the stock market rally is occurring alongside a striking improvement in macroeconomic conditions. The IMF sees the real GDP grow by 6% in 2025 and accelerated to 6.5% year-on-year in the first quarter of 2026. Inflation, which has been one of the country's most serious economic problems, fell to 5.3% in June 2026. International reserves also strengthened, while Ghana public debt restructuring has substantially progressed. The steady Ghanaian currency has also benefited from improved external conditions, including strong gold exports that matter to dollar-based investor, because an investment return measured in US dollars depends not only on the price of the shares, but also on what happens to the local currency. A stronger or more stable cedi can magnify the dollar return for a foreign investor. Nigeria's story is different, but follows a related logic. Reforms since 2023, including the removal of fuel subsidies and major changes to the forex regime, has been painful, but have also begun to improve some underlying economic indicators. The IMF estimates that Nigerian GDP growth at 4.1% in 2026, while noting that inflation has fallen substantially from the extreme levels seen after the reforms. even though renewed food and energy constraints remain a risk. That is where the stock market story becomes interesting. Investors are not necessarily betting that Ghanaian or Nigerian households are already prosperous. They are betting that the economic trajectory of those countries is improving enough to increase the future value of their companies. For businesses, lower inflation, a more predictable exchange rate, improving government financing, and greater investor confidence can change the outlook dramatically. Banks can become more valuable when balance sheets strengthen. Companies with strong pricing power can protect earnings. Exporters can benefit from commodity prices. Firms that survived previously economic shocks may become particularly attractive when investors believe the worst of this adjustment has passed. But a rising share price does not automatically mean rising prosperity. This is the uncomfortable part of the story. Stock markets gain accrue first to people as well as institutions that own shares. Those may include pension funds, insurance companies, investment funds, wealthy individuals, foreign investors, and employees or founders with substantial equity holdings. Someone who does not own shares does not receive the market headline return simply because the index rises. There is therefore a distribution problem behind the impressive numbers. If a country's stock market rises 60 to 70% while wages lag behind living costs, unemployment remains high, or households continue to struggle with essential expenses, it would be misleading to describe the market performance as a proof that the population has become 60 or 70% richer. Nigeria provides a particularly sharp warning against that interpretation. The IMF reported in June that 63% of Nigerians were living in below poverty, under the national poverty line, while an estimated 77 million Nigerians experienced food insecurity in the term of 2025. Those figures can coexist with the booming stock market because the two measures are answering completely different questions. Ghana has made considerable progress on inflation and fiscal stability, but it too faces a difficult transition. The World Bank notes that household welfare continues to be affected by issues including rising electricity tariffs, weakness in cocoa sector, and large infrastructure financing needs. That's why the next phase of story should not be judged by another percentage point gain on the stock exchange. The more important project management question for policy makers is what happens after investor confidence returns. Can capital market gains help companies expand production? Can cheaper or more accessible capital finance factories, technology, housing, logistics, and energy? Can profitable listed companies create enough productive employment to broaden the benefits? Can pension and investment systems bring more ordinary citizens into legitimate long-term investment rather than leaving wealth creation concentrated among the relatively small pool of investors? Those are the deliverables that matter. There is also the risk of celebrating the rally too early. Extraordinary returns often attract speculative money. Investors who see a market rising rapidly can enter simply because prices are rising, rather than because company fundamentals justify the valuation. That can create a feedback loop. Prices rise, and tension increases, more money enters, and prices rise again. Eventually, if the earnings fail to catch up, the process can reverse. Currency risk is another factor that cannot be ignored. Recent Reuters reporting has shown that both Ghanaians' cedi and Nigeria's naira remain exposed to periods of dollar demand constraint, even as their broader outlook has improved. For a foreign investor, therefore, a spectacular local stock market gain can look very different once converted into dollars, and the reverse is also true. There is a further issue for market depth. A stock index represents the companies included in that index. It does not represent every business in the economy. Small enterprises, informal businesses, farmers, as well as millions of workers may have little or no direct connection to the listed equity boom. A rising index can therefore be an important signal of improved financial conditions without being a comprehensive measure of economic well-being. Ordinary investors must be careful not to confuse a headline market return with a guaranteed personal return. Ghana Security and Exchange Commission has recently warned about unlicensed online investment platforms as well as fraudulent schemes, a sign that the excitement surrounding the financial market is already creating opportunities for abuse. The constructive interpretation is that Ghana and Nigeria are demonstrating something important. African capital markets are capable of responding quickly when macroeconomics credibility improves. Investors are willing to price the possibility of a strong corporate earnings, better financial stability, as well as improved economic management. The critical interpretation is equally important. Investors' confidence is not the same as mass prosperity. The real test now moves from trading floor to a wider economy. Governments need to convert stabilization into productive investment. Companies need to convert higher valuations into expansion and jobs. Regulators need to deepen participation while protecting investors and financial institutions, which need to make legitimate investment accessible beyond the traditional wealthy and institutional investor base. If those connections are built, today's stock market rally could become more than an impressive statistics. It could help finance the productive economy that creates jobs, raises incomes, and expands the tax base. If they are not, Ghana and Nigeria may simply have produced two of the world's best performing stocks market, while leaving too many of their citizens watching the celebrations from the sidelines. That is the real measure of whether this boom succeeds. Not how high the index goes, but how far it benefits travels. So thank you for coming this far. If you are here for the first time, please consider subscribing to this channel. You can watch other videos that we have made on different topics. So thank you, and let's meet in the next one. No.